Hello, my name is Vincent Scarsella, Director of Research and Investment Development at Sgroi Lawley. In today's edition of Market Moves, we will be covering everything that happened in the third quarter and what we are seeing heading into a very busy last 3 months of the year for the markets. So much for September being the worst month of the year for the stock market. Through September, the S&P 500 is up just over 22%, while the tech-heavy NASDAQ is right behind, up 21.85%, with the Dow and small caps, as measured by the Russell 2000, lagging slightly, up 13.9 and 11.15% respectively. The S&P's gain of over 22% is better than every single major investment firm's expectation heading into the year. The S&P has made 43 new all-time highs through the end of the third quarter, which is the best first 9 months to a year in 27 years, and is also the best start to a presidential election year on record going back to 1928. For the month, the S&P gained just over 2%, while the NASDAQ rose 2.75%, the Dow was up 1.96%, and small caps were up slightly, rising 0.7%. For the third quarter, the S&P rose 5.9%, the NASDAQ was up 2.75%, and the Dow gained just over 8.7%, and small caps led the charge, rising 9.3%, as we saw the rest of the market play catch-up to the NASDAQ and the S&P. The S&P's gain for the quarter was the fourth quarterly gain in a row for the index. What has been remarkable so far this year anyways, is how placid the stock market has been. Despite a flurry of negative headlines, the market keeps chugging along. Except for a quick 3-day panic in August, the market has been remarkably calm. It has also been a tale of two different markets. The first half of the year was characterized by growth, once again outpacing value. But in the middle of the year, value started to take the lead. And although we have seen this in the past, where value names outpaced growth and fizzled out, there are some reasons to believe that this could continue. As long as the Federal Reserve is committed to lowering interest rates, that is usually good news for higher yielding sectors of the market. What has been driving the shift to value? Fed rate cuts are playing a big role, and it looks like more rate cuts are on the way. Personal consumption expenditures, which is the Fed's preferred measure of inflationary pressures, rose by just 0.1% in August, which was less than expected. Over the last 12 months, the PCE is up by 2.2%, which is the lowest 12-month rate since February of 2021. It may be too early for the Fed to take a victory lap around inflation, but the outlook is getting better and better, which is why Fed Chair Jerome Powell has shifted his language from taming inflation to supporting the labor market. The Fed will meet next on November 6th and 7th, and it is widely expected that they will cut rates again. As Powell has stated, they will keep lowering rates to help keep the economy going. Fed members see the central bank cutting by 0.5% or 50 basis points before the end of the year. These rate cuts are not so much about the Fed helping a weak economy. Instead, it can be viewed as the Fed taking back its aggressive rate hikes that were used to combat inflation. With inflation on its way down, they can lower rates to not be as much of a headwind on the US economy. All of this is a great segue to the fixed income market, as the bond market is heavily impacted by where interest rates are going. The Bloomberg US Aggregate Index, which is comprised of US government bonds and other highly rated bonds, started 2024 down over 3.2% through April, as investors had to reprice bonds due to economic data coming in better than expected. As it was widely held, the Fed would cut interest rates 7 times coming into the year. With inflationary pressures easing and the Fed telegraphing that rate cuts were coming, the bond market responded well. Since the low on April 30th, the AG is up 8% and could be that ballast in the portfolio that investors were accustomed to in the past. All in all, the AG is up 4.8% as we head into the fourth quarter and was up 5.2% in the third quarter. Rounding out our recap of the third quarter, it is important to discuss the world's second biggest economy, China. In the last week of September, the Chinese government announced sweeping stimulus measures to help bolster their weakening property sectors and economy as a whole. There was a lot in the stimulus package, and we will see what actually comes out of this, but their stock market responded in stride, rising almost 29% in September alone. We believe that markets in the last quarter of the year will be driven by further rate cuts, the US election, and likely volatility given political and geopolitical uncertainties. Another thing we are closely monitoring is the tensions in the Middle East between Israel and Iran. The base case for many is still not an all-out war between the two, as Iran did suggest its attack was over for now, barring any further aggression from Israel. However, the risk of a miscalculation by Iran, its allies, or Israel continues to increase. All in all, the headwinds heading into the fourth quarter could cause some short-term volatility. However, there are plenty of things to have optimism over. First, the probability of an all-out war between Israel and Iran is limited, and energy flows should continue without interruption. Meanwhile, the outlook for equities can be supported still by a soft economic landing here in the US, combined with Federal Reserve rate cuts, strong earnings, and optimism over artificial intelligence. While we could see volatility in the coming months, we do not believe major portfolio adjustments are needed in response to all of this. Historically, the effects of international conflicts on markets fades fast, as studies show that since 1941, the S&P has been higher 2/3 of the time in the 12 months following the start of a geopolitical crisis, and half the time, markets have taken just a month to recover. Much of what is to come will be based on incoming economic data and Fed policy response. Thank you for tuning in to this edition of Market Moves. If you have any questions, please do not hesitate to call Sgroi Lawley.